Mapetere, and I'll be going through the ITC Mock 2 solution for your revision purposes. The objectives of this recording is, first of all, for us to appreciate the scenario, the things that you could have done at a scenario reading stage, and then moving on to your required, picking out the things that you should have noted for the purposes of dealing with your required. And then lastly, obviously, would want to go through our solution. Not necessarily to run down through each and every point in the solution, but just at least to get a workable approach as to how you could have taken the question. So in the scenario, you would see that it is basically two sets of emails that are being sent, and within those emails, there are tasks. You're given a bit of a background in terms of the entity that we are dealing with. And in there, our expectation is you'd need to understand that business based on the information that you've been given. Never mind for tax purposes, IFRS purposes, audit, or even your MAF, your managerial and accounting for finance. So it was going to be very important for you to first understand the business involved and the model around that business. And then your next issue is in the scenario is to get into the key transactions. So one transaction was a sale and leaseback. So it was important for you to break down the sale and leaseback. And then also there was a transaction that involved inventory. So when you look at, let's start with the lease transaction. You had to check what kind of lease it is. What were the details around the lease? In this case, it was a sale and leaseback. It was arising out of a need to capitalize the business. When you look at the inventory transaction, there were issues to do with inventory obsolescence and any allowances that were being calculated, the inventory balances themselves. But within that story, we're being told how the sales were being done for those inventories, and it was very important just to have an appreciation of those transactions. So let's get into the whole story in terms of the scenario. And we're saying, since we've said number one is to understand the business and the business model. What industry was this taxpayer operating in? It was in the retail sector. They were not manufacturing anything, and their market was the mass market. It's just very important for you to have an understanding, and this is a departure point where you will not be able to come up with solutions to challenges unless if you understand the model. So that was the industry. What were they selling? They were selling clothing and leather products. What were their delivery channels? They were using stores. This particular model was limited in terms of the technology. But just for your understanding and appreciation, you will find that our exams, or the CTA examinations, ITC examinations, APC examinations as well, your whole qualification model is beginning to look at more and more into the future, so that the CA that is being produced is relevant in the future, CA 2025. So it's very important for us to start looking out for disruptive models to the traditional one. So in retail, in the retail industry, although this was not the case in this one, you'd be very concerned about things like how you use mobile technology, mobile applications to do your shopping. Very important. How to account, how to big data, how it's going to be used in coming up with various things in and around the retail industry business. I can think off the top of my head that if you're going to have provisions, one would need to provision for, say, for bad debt. One would need to use big data to do the estimation process for you. And it's going to pick on a lot of things, and it will use a lot of IT. So coming back to our particular one, you had these stores, you had limited technology in the model given, which was a plus for you. You also had large volumes of inventory. It's also important, apart from knowing the products, the delivery channels, it's also important for you to know the assets that are being utilized. This model in particular uses a lot of PPE. You also need in-store equipment. So all these things are going to be part of the business. And naturally, tax consequences will arise from that business model. But beyond understanding the assets utilized, it's going to affect a lot of things, including pricing. And from time to time, you start having issues around transfer pricing where you have group arrangements, branch arrangements, although for tax purposes, all branches are within one taxpayer, so you would not really have tax transfer pricing issues. But you can have intercompany transfer pricing where then it is going to be very important for you to interrogate the price of a commodity. And one of the key issues around pricing a commodity is you can benchmark against the cost, adding a markup to that cost. And in coming up with the cost, it depends on the various models that are being applied. Some models are asset intensive, and they could easily come up with fixed costs and any other costs that are high. So the markup is only coming through when the cost is already very high. Whereas some businesses are not asset intensive, and as a result, they have a very low cost. So the markup is going to sit on top of a very low cost. So point being now, the final price is determined whether it is fair or not is a function of the cost structure, and assets utilized form part of that cost structure. So it's very important for you to have a very strong appreciation of what you've been given in the scenario in terms of the business model, for you later on to come up with a lot of other judgment decisions, such as whether a price is at arm's length or not. So in this case, you would have in-store. In terms of understanding the business model, one other aspect that is very important to understand is your risks. So before you get any question around this examination, it was important for you to understand that since already there were pointers that there are going to be issues around inventory, it was key for you to appreciate the risks involved when it comes to inventory, its disposal, etc., etc. The markets would be an issue you'd want to understand, the risks around your retail markets and the clothing sector, the mass markets. Is it about seasons? Because obviously when it's in the cold season, you expect certain type of clothing to be fast moving. What about obsolescence, in the sense that sometimes fashion is not repetitive, it's cyclical, yes, but what was fashionable in the last similar season may not be fashionable in the next or in the current similar season. So yellow could have been the in thing last summer, but maybe blue is the in thing this summer. So that gives you an appreciation of what to then expect, even when you start having these obsolescence allowances. Their reasonability is already tested because you have the value drivers around that transaction. So the business model is very important for you to try and appreciate and get a grasp. Some of the things that you need to consider may not necessarily be in the scenario itself. They come through because of your general understanding of the various business models. This then brings me to a point that it's very important for you to be widely read. Appreciate as many industries as you can. You absorb some of these things not for scholarly purposes or academic purposes, but just for your general awareness of how things work. it will work to your advantage when you're now in an examination and you have to make certain judgment calls. Other risks involved are not necessarily associated with the entity, are not entity specific. You can have risks to do with the economy. Take Zimbabwe, for example. If you were high-end leather products, selling high-end leather products, or even the clothing themselves, you would need to be able to understand how our economy works. You have a lot of boutiques, you have a lot of ways that are being imported, cheap imports that are being dumped and coming through from our porous borders. So you find you have street sales where clothing items in US dollar terms can be bought for as little as $1. It's very important for you to understand this kind of setup because it will have a knock-on effect on a lot of items that are already in your scenario, such as the inventory and the obsolescence allowances. So that's it. The list on risks is not the one that I have just itemized is not complete. You still need to call on your skills or competencies learned elsewhere, especially in your MANAC, where you were being taught how to do a risk assessment, or even your audit as well, for you to have a full understanding of the scenario. One other area, apart from the ones that have already mentioned, is as much as is possible, if you can, decipher from your scenario the funding model. It's going to be very important for you to understand how this business is funded, because the funding model will have its implications for the various disciplines, be it the accounting, how it's going to be accounted for, how it's going to be audited, but most importantly for us, how you're going to tax. So that's so much about the understanding the business. Moving on to the lease transaction itself. You had a sale of a building, which was then leased back immediately. So for reporting purposes, in substance, what is happening there is the taxpayer is borrowing. They sell the business, they get the proceeds for the disposal, and then they lease it back. Since it's a finance lease using the old model, it means you're going to be using this business over most of the useful life of the asset. So these rights you have to use the business, the asset rather, implies that you still have the asset, you are still similar to someone who owns the asset, and therefore the proceeds were actually there. So the lease rentals are now the payback for the borrowing that you have done. So this is very important to understand that this is how IFRS is going to treat it. First, because in practice, your taxation is only going to come through after you've done your accounting. And therefore, you're going to calculate the tax by way of adjustments. But in principle, for tax purposes, there are two transactions. There is the sale and there's the lease. It takes the form of the transaction rather than the substance. And just to note, I hope, just in case I don't pick it up on the solution side, it's very important as well as you start explaining these things in your solutions. If you've been required to discuss the sale and leaseback, although for calculation purposes, you're doing it via the adjustment route, for a discussion type, you don't need to be discussing the adjustment unless you've been told that you're starting from your net profit before tax. So that's the first part of the lease. The second part of the lease is, as they were now leasing, the taxpayer then improved the asset. And so it's going to be very important for you to be able to discuss the improvements of this lease. So it was very important for you to understand what was improved under the lease, because improvements have their own tax implications. Or were the improvements mandatory, were they voluntary, and you even need to drill down into the improvement itself, because whilst in the scenario it may be called an improvement, but for tax purposes it's not an improvement as defined, if ever there's a definition for improvement. So just as an example, just to explain that bit, someone may change wooden floor tiles and put porcelain floor tiles. Essentially, the change to porcelain is not changing the income generating capacity of the room or the fundamental functionality of that room. So that is not considered to be an improvement which is of a capital nature for tax purposes. It's actually a repair, and therefore you can claim an allowable, the deduction, the cost of that is an allowable deduction in the period in which it is incurred. So it's very important to further understand the improvements in the transaction. You also needed to understand the type of lease, the type of the asset that was being leased. It was a building. The lease cash flows, if there were any. Did you have any premiums? It's crucial to have an understanding of those before you start answering your questions. Were there any lease rentals, and were there improvements in the leases, just as we have just discussed? Right. So the next item was the inventory transaction. In the inventory transaction, what you had were obsolescence allowance, and so you needed to drill down to say, how do they come about? Therefore, you're already thinking tax, to say, can I get a deduction for this? Because this is going to be an expense item for accounting purposes or reporting purposes, but can I get a deduction for it? And what are the rules around deductions? Key item could probably have been incurred there. Then there was the customer loyalty program, which you needed to understand its operation. How at what point are points vesting? When are you going to be refunded? Are you going to be given a discount for it? So it was very important to understand the operations of the customer loyalty program and how it was being accounted for you then to be able to treat it for tax. So in a nutshell, it was important, and still is important in any examination, for you to not to dive into coming up with a solution before you fully appreciate and break down the scenario. Normally, this gives you an advantage where you have discussion type questions, which are the bulk, as it were. Completeness is usually an issue, where as you're reading the scenario, you get excited. It's easy to get excited about a few items that are very familiar and which you know and indeed are going to get points and marks for. But for a 10 marker, sometimes when you get to the 6th point, you start fizzling out and it's very difficult to come up with new points or discussion points. And of the 6, you're not guaranteed to get all of them right. So in some cases, you end up out of 10, you're being marked out, you are working out of 6. And even if you get half of those 6 correct, it still means you are 3 out of 10. So it's very important for you to break down the transaction, see how much you understood about the transaction, so that as you start moving to the solution, you're very equipped with a lot of technical or details around that scenario. Moving on to your required. First of all, the structure of this particular required was a bit odd and intentional, where what we did was we moved the details of the required into the scenario, which is on the extreme side, to say within the bodies of the emails, you found instructions that were being given within that email, and then that would become your required. So it was very important for you to break down the details that were in the email to see whether you've been given any information or any tasks within the scenario, so that you are able to deal with those and score your marks. The required as well, what was also pertinent about those required was they were quite open-ended. They were asking you to discuss tax treatment of a sale and leaseback. That is very open-ended. Yeah, be it VAT, be it income tax. But the fact that you're just being asked to discuss the tax treatment, it means you have to go the whole 9 yards. You have to first understand, as we have already done, what components are within a sale and leaseback. There's the sale, then there's the leasing back. Within the leasing back, there are improvements, there are rentals, there could be premiums, and so on and so on. So itemizing these things was going to be very important, so that you know how many key aspects of the sale and leaseback am I going to discuss, and then you then need to move into the discussion. So this was deliberately open-ended, meant to test your ability to identify issues, to identify the issues to discuss over and above any of the obvious ones. So in a sense, we just want to see how you can run with completeness when it comes to a transaction. The required also went for the tax treatment of the obsolescence allowance. You had to understand the obsolescence allowance first and how it comes about. You also had to understand the inventory balances and how they work for tax, the revenue on credit, on credit sales, the revenue received in advance. These would then test the changes that happened in 2018 in terms of how you treat revenue received in advance. So it's also very important as well to always have the refreshed changes in legislation every time as you're doing your study, because this could easily be examiners' playgrounds, just to test whether you understand new concepts that would have come through. You were also required to discuss the tax implications of the customer loyalty program, both VAT and income tax. So it was very important to understand how many things that I must discuss. Just to pick out the number of things to discuss was going to be a crucial aspect of the examination. The tax heads were varying. In some cases, you were asked to discuss including this capital gains tax, and in some cases, there was no capital gains tax requirement. The scope was very important. Which transaction is being queried and for which tax period? So that's so much about the required. Moving on to the solution. Starting with the sale and leaseback, you needed to discuss the sale and issues attendant to the sale. Let's start with the income tax aspect of the sale and leaseback. Issues to do with the sale. First, you are selling an asset. So what items that are revenue in nature are around this asset during the tax period? First, capital allowance. What's this asset claiming capital allowances? And how do you treat capital allowances in the year of disposal? That was going to be very important. The second thing is closely related to capital allowances. Since the disposal of this asset is capital in nature and therefore the proceeds are capital in nature and not included in gross income, you still have any recoveries of capital allowances previously granted that may be included in gross income as a reversal of those capital allowances previously granted. The details in the scenario showed that you are responsible for the insurance of this asset. So before you sold it, you were insuring it. When you started leasing it back, you're still insuring it. All these items would need to, the insurance would need to be discussed. You also would look out for things like repairs, revaluation surpluses on the PPE. Why revaluation surpluses? Normally, for accounting purposes, these may be included in your profit. So you would want to know at what point, how have they been accounted for, and therefore, what do I need to adjust, if any, for the purposes of coming up with my income tax. The VAT aspect of the sale was, it's a supply of goods. So you need to get into that to say, is there any VAT that is going to arise since I've supplied a building? The classification of that supply is going to be important. Is this type of building, when you sell this kind of building, is it a standard rate, zero rate, or is it an exempt item? The time of supply is also very important. This is the disposal of a fixed property. You would need to get into the details of the transaction to see when was the agreement entered into, when is the transfer of title happening, and so on and so on. This then determines whether or not, at what point the VAT will arise. The value of supply as well, is it the consideration less VAT? How related are we to the person who we sold it to? This will tell us the value of the supply. In terms of CGT, first you have to identify whether this was a specified asset, whether you have to relate it to the recoupment, because the gross capital amount excludes any amounts that were included around that transaction for income tax purposes. So the recoupment was very important, as it will be used in the computation of the capital gains tax. And as well, any allowable deductions for CGT purposes, your cost, your inflation allowance. So the details were very important. In this particular one, I think you would observe that the asset had been acquired before 2009, which is the date which we dollarized and moved from the Zim dollar to our US dollar, multi-currency regime rather. So because of that, the capital gains tax is going to be 5% on the proceeds of the asset. In terms of your lease, it was important, as I mentioned earlier, are they improvements really, or are they repairs? Because if they are repairs, then you're not really worried about on the lease side. You're worried on the income tax side, and you just get an allowable deduction for repairs as long as they are being incurred for the purpose of trade. But when it comes to improvement, you would then need to take a decision whether the improvement is voluntary or mandatory. If they are mandatory, then you get a lease allowance, which is spread over the life of the lease or 10 years, whichever is the lesser. When they are mandatory, you have an option to get that same lease allowance, or you're looking at capital allowances on the improvements of those leases. So it's very important for you to have an understanding of the lease details. The VAT on the lease question was, is it a rental agreement or installment credit agreement? Given that this is fixed property, it therefore can't be an installment credit agreement, and then you'd move to the rental agreement. But even then, you'd start looking at the time of supply and the value of supply, which have specific rules when it comes to disposal of fixed property. or renting out this property. Again, since you are the lessee, the issue around those lease installments is, should you be claiming input tax? So the question is, where you charge that input tax, and what are you using the asset to do? For you to know whether you were charged or not, you'd still need to look at it from the shoes of the lessor and still come up with the whole 9 yards, which I've already discussed in terms of the value of supply and the time of supply to the lessor, and so on. Coming to the inventory transaction, it was important for you to appreciate whether it's a credit sale, and there the key would have been, when are we accruing? In terms of the inventory itself, because the required was for you to look at the treatment of the sales, but of the inventory itself as well. So I think one of the most important things there was the amount on the inventory. What is an acceptable amount as you include closing inventory in gross income? But the opening inventory, which was the previous period's closing inventory, automatically becomes an allowable deduction. But at what amount? And whilst IFRS allows net realizable value or cost, net realizable value is not an acceptable inventory valuation method for income tax. You just needed to appreciate those factors and be able to discuss that. In terms of the obsolescence allowance, this will be an expense item as long as the allowance, the change in allowance every year is an expense, is likely to be an expense item for as long as we are further allowing for obsolescence. And the question for tax purposes before you can get a deduction is, has it been incurred? And one of the key characteristics of an expense having been incurred is, has an inescapable obligation to actually pay been created. And at this stage, this would not have happened, and your ability to discuss around this, including any case law, would have been very important.